Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have George Schultze, founder and managing member of Schultze Asset Management, to discuss deploying capital to distressed debt strategies. George, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me, Jill. It's good to be back.
You got it. Before we get into the strategies, I want to get your thoughts on the macro indicators. We got another 25 basis point interest rate hike this week. Inflation data is starting to come in, albeit slowly. Wages are still high. Labor's still hot. What are your thoughts on the macro?
Good questions. Yeah, so we're seeing some growth in the GDP, about 2.6% year over year. Consumer price index, inflation, still about 3% year over year. So you're still seeing some inflation. I think that's a big challenge for the Fed. The unemployment rate is only 3.6%, still, kind of humming along down record level lows. However, year over year, we've seen money supply contract a little bit, down about 3.6%. And of course, this week, the Fed raised rates again to now a midpoint of 5.375%. So, it's an uncertain time. I think the Fed really has a challenge in their job of trying to tame inflation, and that's why they raised rates again. But most economists don't expect them to raise them again this year, but we shall see. I think, on the other hand, most economists have also taken the risk of recession off the table. But you're still seeing a pretty inverted yield curve. So, for what it's worth, that's flashing signs of, a serious risk of future recession.
Well, the equity market seems to be taking it in stride, but the caveat to that is it's been pretty thin. It's not as broad as I think most strategists would like to see it.
That's right. Yeah, the indices have really rallied this year. I guess the Dow right now is up almost 7% year to date. The S&P is up close to 20%. Nasdaq's up close to 37% year to date. But it's true. Equity market participation is very thin right now. And, it's really fewer than a dozen companies that are leading the charge. Some people call it the Magnificent Seven, some of the tech companies that also have AI. If you strip them out, the picture looks a lot worse, unfortunately, for the equity markets. And I think just generally, that's happened before in history. And when it does, it doesn't really bode well for the future of the of the market. So it's a sign that, investors are sort of being a little bit more cautious with everything that has a little bit more risk than those Magnificent Seven.
Do you think the challenges in the banking sector have been resolved?
Not at all. The main driver of those problems was unrealized losses that regional banks had on their balance sheet, and not just regional banks, but global banks as well. And those unrealized losses, they're driven by higher interest rates. And, in the first quarter of this year, obviously, we had a big banking crisis where a number of regional banks failed. And then globally, Credit Suisse, the largest or one of the largest banks in Switzerland, failed as well. We've gone through, or we're part of the way through the second quarter reporting season for the regional banks. Things are looking a little bit better, but now with interest rates climbing again this week, the problem is still there. These banks still have unrealized losses on their books, and it looks like because rates have climbed again, that problem is going to be worse. So that's one of the big issues for banks, how they can manage, that change in their balance sheet and whether they need to market. It's kind of a systemic issue for all banks, but the regional banks seem to be the worst positioned for it. The other major issue for regional banks and global banks too is commercial real estate. Lots of these commercial CRE real estate loans were underwritten at a time when interest rates were practically zero. And now, of course, cap rates have skyrocketed because rates have, climbed up to about 5.75% right now. 5.375% right now. So, a lot of those loans are underwater. And I think it'll take some time for the banks to truly fix their balance sheet with those issues.
I think it's also important to note that Chapter 11 filings are up significantly for the first, so far this year, not even just in the US, but you're seeing it globally.
That's right. They're up about 68% this year. Just under 3,000 companies have filed for Chapter 11 bankruptcy versus about 1,700 last year. According to JP Morgan, these first 6 months of 2023 in terms of defaults, this was the highest trend since 2010. And you're seeing it globally as well. So there's a lot more default activity and distress activity. And I think most people that follow this sector are in agreement that default rates will stay high or maybe even climb from here going forward, given all the issues in the economy, higher interest rates, an inverted yield curve, and problems with banks.
So with this backdrop, how are you recommending that investors deploy funds into distressed debt strategies? I would imagine that you're being highly selective here.
That's a good way to describe it. Yes, Jill. So here at Schultze Asset Management, we're recommending that clients do a couple things. One, tread very carefully, as you just said. But second, it's a good opportunity right now to focus on short selling companies headed into trouble. That's a growing universe. You can short sell the most junior part of the capital structure of U.S. companies and potentially make some strong returns as more and more companies get into distress. So basically short selling stocks of over-levered companies or companies that are impacted by negative secular trends. If you can find companies that are impacted by both of those, again, excessive leverage, negative secular trends, probably have a bankruptcy candidate and then a really good likelihood of having a strong gain on short selling those companies. On the other hand, it's also a good time to start selectively buying into distressed debt. There's some great companies out there that have bad balance sheets and they're temporarily bad. As they restructure and go through that process, when they come out of the other side, there's a good chance that some of these companies will be great value investments for shareholders.
All right, George, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks for having me.